So this is the next chapter. Chapter 4, entries. Yeah. So entry work. So we're going to start with top-down analysis. We analyze using the different time frames by using a process called top-down analysis, which is used to get entries, but we will go deeper into this and put it into use in the entry section. When top-down analyzing, you start on a higher time frame, such as the weekly or daily, to get an understanding of the overall trend. You do not need to place support and resistance areas on the weekly time frame, as we want to get more specific. Price analyzing, uh, just the daily for major key areas. You shouldn't trade on the higher time frames. They're just to get an overall bias, so you don't really want to place your support and resistance on the weekly or daily. You should when price is near that area. So if price is like nowhere near the area, you don't need to place it. If you see prices getting to a support or resistance that price hit weeks before, then you should mark it. So after getting an overall trend, you scale down when you lower your time frame, which is called scaling down, to the 4 hour time frame to analyze the market, placing your key areas, support and resistance, all the analyzing you do to get an overall bias of price. Then you scale down to the 2 hour, 1 hour, 30 minute, and 15 minute, which are all used for entries, which we will go over soon. The 2 hour can be used for analyzing, but the 4 hour is more strong price action and is more reliable. So setting up the charts. To start setting up your chart, it would be very helpful to first find your support and resistance, trend lines, key areas, or anything that can help you gain a bias on why price is moving the way it is. Set your charts up so they are visually appealing to you, your eyes, and work for you. Pairs you should and shouldn't trade. Beginner pairs, all of the majors, easy, understandable market structure. Euro USD, GBP USD, USD JPY, AUD USD. Intermediate pairs, which are minors that move like majors but with a lot more volatility. GBP AUD, GBP JPY, CAD JPY, AUD JPY, and these are advanced pairs, very volatile, do not trade unless very experienced. Gold, NASA 100, US 30, Bitcoin, things like that. So as discussed before, market structure is the way you see the price, the way you see the market based on what you see on the charts. To get a deeper understanding of what market structure is, understanding what a break-even market structure looks like and doesn't look like will help achieve this goal. So this is market structure, a downtrend, lower low, lower high, lower low, lower high, lower low, lower high, and then this is a breaker structure when the price breaks the previous lower high. Same thing with a uptrend, higher low, higher high, higher low, higher high. Price breaks the previous higher low, then we're in a downtrend. And we can see when price is not broken, higher high, higher low, higher high, higher low, higher high, higher low, and price did not break this area, but it still came down, but it did not break below this low. Same with the downtrend. So hold on. Okay. So where to place your take profit and stop loss, when to buy and sell. To know where to place your take profit and stop loss, you need to be aware of market structure. It will tell you where to place your take profit and stop loss when looking for entries in price. We can look at an example of combining top-down analysis with the market to find take profit and stop loss in tough market conditions. This goes hand in hand with knowing when to buy and sell, as market structure and building a keen eye for understanding market patterns and knowing why price may move where it moved and where price may move in the future will be critical to your trading. So now we're looking at the charts. Let's analyze price from top to bottom. So we're just looking at price. And first we start on a daily, then we'll put our major key area levels, which would be 1.97500, 1.9500, and 1.92500. Since price is closest to these areas, as you can see, we're not gonna put 1.9 flat because price is all the way up here. We're gonna place it at these areas as price is closest to these areas. We could really only have these areas, but I personally like to have a third one. So we could go to the daily just to get an overall feel for the market, but we'll focus on the daily more. So we could put this major key area on the daily due to its strength. This is a major key area as price came here many times, then dropped from this area. As we can see here, came here, consolidated, boom, 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 couldn't break above, dropped below. Price is at the same area now. So as you can see, price is in an uptrend and is retracing. We can place a Fibonacci here too. But price has reached a very strong area, a very significant area, and then dropped. So as price reaches areas like this, we want to see a strong push through or a tap of the area, then retracement, and then a push up as we see price doing now. When you're trading, you should look at price with an if-then mindset. A clear example of this is that if price comes down to the support, which is also the 50% Fibonacci retracement, and gives us some sort of candlestick pattern, respects a trend line, gives us a higher low, then we will enter for a buy to the previous high. Because of the strong area price is at, the negative 27 wouldn't be my main take profit. If price gets there, then cool. But my take profit would be at the previous high. Since price is still in the uptrend, we can be confident price will get to this area at least before dropping down. But I don't know that unless price pushes up. But I don't think that unless price pushes up strongly, then we're going to go up. But if price breaks below the trend line and then creates a lower high, then we'll enter for a sell. A sell. We can now scale down to the 2 hour or 1 hour to get a more precise analysis of price. I don't know how that types. So as we can see, as price reaches this area, we can scale down again to look to the 15-minute time frame to look for entries. And price reaches this area and then creates an inverted hammer and then a momentum candlestick showing me that buyers have the power and to enter for a buy. Stop loss would be below this area as if price goes below. Stop loss would be below the area as if price goes below this area, then we could be confident price is going down. It also aligns with market structure as this is a significant support area. Our take profit would be at the previous high. This would be a short trade, but we can be confident it will get to this area as price is still in the uptrend. And if price were to go up and then go down, we can be confident it would match the high, then drop down. Give us a double top and a lower high, and we could sell once it breaks the trend line. As you can see, price creates a higher low. If price would have stopped us out, we could have been confident price would continue dropping. So we can stay in this trade. As we can also see that price created an inverted head and shoulders here. You can see here. And also we can never be like 100% confident price is gonna do this or that. We're simply speculating. Price is never going to do what we want it to do. The markets is a player of games, a game of players. So it's a bunch of people making decisions, and that's why price is moving. So we can never 100% rightly predict because price can do whatever it wants. So as seen, price gets to this area. After entering a trade, we scale out to the 1 hour and watch price create true market structure, or even the 4 hour to just see price for what it is. Now we are watching price. If we don't see a break of this area, then we are bearish and looking for sells down to the previous key area, which is 1.9500. As price drops, we scale down again to the 15-minute to see market structure. And as we see, price wicks all the way up to the area where price stopped at many times and then closes 40% of the candlestick. Um, that's more like 10% of the candlestick, showing us that price has no bullish momentum and we could sell down to the 1.9500. We can enter here with the stop loss above the area where price wicked at and stopped at, and take profit at 1.9500. As you can see, it says 3.11 risk to reward. That means your take profit is 3.11 times more than your stop loss. So you would win 3 times more than you would lose. And if we look here, we could see that it says the 3.11 to reward. That's how it would look like. So as we see, price drops straight to this area, and this is a trade that would have been profitable. Now you could have also entered here, over here, as price created a lower high on the trend line, giving us no here. You could have entered here as price creates a lower high on the trend line, giving us influence that price is dropping down, and as seen, we would have gotten stopped out. But the way to have avoided this is to have either re-entered that trade, or re-entered that trade if your stop loss was right above the area, which it should have been, or have had your stop loss at this area, as in the past, it wicked at this area right before it dropped. So we could speculate it would get to this area and then drop. If not, we get stopped out. We could simply get in the trade again if we got stopped out. So if we would have entered here with our stop loss right here, look, I don't know if I could draw. If we got stopped out with our stop loss right here, how do I remove this? Oh, yeah. If we were to get stopped out because we had a stop loss right here and it stopped us out right here, we could have either re-entered as we did here, re-entered for the trade as we did here, or entered and had our stop loss above this area, because as we see, price wicked above this area, it broke below, came up to retest this area, so we could have had the same confidence that it would have broken below and come up back to the same area and then drop down. So that is what we had. Showing the risk to reward. Oh, let me remove this. So scaling in and out. I've talked about scaling in and out, but there's another aspect to scaling into trades. Scaling in is when you enter another trade. When price creates more structure, so when price creates a lower high in a downtrend, you enter the next lower high price creates, you can re-enter for another trade. Once again, we set up our key areas and begin analyzing on the 4-hour time frame. We are waiting for price to reach 1.9500 so we can see what price will do and analyze on a lower time frame. So we want to wait for price to reach one of our key areas, because we cannot trade price when it's in the middle of nowhere. Like price right here, you could look at this lower high, but like we can't really trade it with confidence. Once price gets here, we could be like, oh, boom, rejected, created a lower high right here, enter here, boom. But we can't really trade when price is in the middle of nowhere. But we could trade for a scale in after we get in here. So we could have got in here, lower high, boom. We see another lower high, enter here, boom. But we don't want to place a main trade when we're like, oh, stop, I missed on this trade. Boom, enter here and take profit all the way up here or something, or up here. But yeah, so we waited for price to reach this area, and as price reaches this area, it breaks above, then retests. So on the 15-minute, we are looking for a confluence to tell us price is pushing up, or we can see a push down and then a break below the level. Price then pushes oh, as price reaches here, we can see price firstly creates a wick here, right here. Wait, a wick here. This is a higher low price creates, and now we're looking for price to break above this area before price came down. Oh, right here. So we see price push up, come down, create this wick. So we're looking for price to push up. So as price then pushes down and is unable to break through this area right here. The moving average crosses over as you can see, and we're waiting for a break below this wick so we can enter for a sell. So we can now enter for a sell with our stop loss above the last highs, which is here, and our take profit is where price stopped before pushing up. Price breaks through this level, so we can now be confident it's going to drop down. We'll talk about where our TPs could be later. So this is our last area where price stopped at. Actually, I'll say it now. So our TPs, we can have our TPs either at our Fibonacci areas, support and resistance, which is basically where price stopped at in the past, which is this like previous price movement, and the next key area. But we don't really want to go key area to key area because sometimes price will get to where price stopped at in the past and then push up or push down. So as price is dropping, we must wait for a retracement and then a push down to re-enter for another trade to scale in to the trade. As price is coming back up, we can scale down to the 15-minute time frame and wait for price to give us a strong confluence to enter for a sell. There's also something called scaling out, scaling in and out. So scaling in is when you enter another trade, and scaling out is when you remove like your positioning. You know, you remove some of your lot size on the trade, or you get out of the trade. So here we can mark this level price retraced to in the past on the 15-minute level, the 15-minute time frame, and now we can wait for price to drop down and react off this level. Price creates a strong rejection candle, so I am going to enter as a scaled in trade, another trade within my main trade, which was this huge one here. We could see which we entered at the key area with the same take profit, and my stop loss is above this area, so my risk is tight. So here we can see take profit was reached, and we are able to scale into the trade. Scaling in tends to be more risky, as price can create more structure that is insignificant to the 15-minute. So it could have kept pushing up, but on the 1 hour, it would have been it would have been a few just straight candlesticks of price pushing up, and then it could have pushed down. But that's why it's pretty risky to just do it on the 15-minute. You gotta minimize your risk because you never really know what price is gonna do. You can never get the most perfect entry. Sometimes you are gonna get stopped out. So, but more visible on the 1 hour. Create structure insignificant on the 15-minute. More visible on 1 hour. This is where your personalized tendencies in the market come in, and where you scale out constantly to see the overall price movement. Scale out as in go to a higher time frame. So when scaling out, it is important to not put on as much risk for the scale ins due to the risk involved. Remember, nothing is guaranteed when trading, so be sure to have as many confluences as possible. You need to be confident in the trade, always scale out, and look for a market structure. Well, next one is entries at key areas, but that is it for now.